Good morning, everybody. It's Monday, May 13th. I look washed out on the screen here. I don't know. I got maybe too many lights going on here. Let me fix the video. As you know, this is a one-man show, so I'm doing it all. Anyways, it's also a little bright outside, but even though it's cloudy, you may be wondering what I'm wearing here. As some of you may know, Max, my King Charles Cavalier, is starting to develop a cult following. He's had some pretty good calls on the market. He's usually here. I don't know where he is at this time. He may come visit. But we figure if people are going to start following Max, maybe Yardeni Research should start a fashion department. So this is a hoodie with Max on it. My wife actually gave it to me as a birthday present, so I'm enjoying it. It's keeping me warm. But at any rate, maybe Max will make an appearance, and then there's always Bailey and Cooper, and then of course Chloe, and then my mother-in-law's visiting us. So Oscar is here. So we've got eight puppies in the house. Anyways, so much for the fun stuff. Now let's get to the professional stuff, which also tends to be fun. It's never a dull moment in our business. Sometimes you kind of wish it would get a little bit duller, but all in all, we're having I think a good time, and it's been it beats having a bear market. And this one had a bit of a correction here from up April until late April until now. We've actually seen a nice rally. The market, I think it was March 18th, hit a top. But at any rate, it's made quite a U-turn, as we wrote up in the quick takes that we sent out last night. Had the wrong date there for the bottom. It was not October 19th. It was April 19th. So some of you caught that. We'll try to avoid such data mistakes. But at any rate, let's talk about what is in everybody's mind. I've been getting a lot of questions about the consumer and whether the consumer is going to roll over. Usually, the way it's asked is, are consumers starting to crack? The idea being that there's this strong wall of consumer spending, and that consumers are starting to show signs of stress of crack in that wall. And if the consumer winds up retrenching in their spending, that's obviously going to cause a consumer-led recession. So, although we had the past 2 years where recession forecasts have been wrong, it's been a Godot recession, the most anticipated recession of all times that never happened. I think a lot of people just can't let go of that idea that it's still coming. It may still be imminent. I know that one of our competitors is saying that we're in a recession right now. Another one is saying that we're going to be in a recession later this year. So there's still that kind of talk out there. But meanwhile, the stock market, it's not too far away from its all-time record high, and it may very well make a new record high. We're still using 5,400 on the S&P 500, even though we're at a little over 5,222 last I looked. So we're getting awfully close to our year-end target ahead of schedule. Same thing happened to us last year. We were talking about the market getting to 4,800 by the end of last year. Can't remember whether it was 4,600 or 4,800. You'll forgive me, 200 points of not recalling exactly what it was. But I do recall that we got to that kind of level by the middle of last year. And then we stalled out. So we didn't change our numbers. Yeah, I think we were at 4,600 and it ended up at 4,800. So it was even a stronger bull market than we had anticipated. And maybe that'll be again the case this year. But as you know, we think we're in a bull market. We think we're going to see 6,000 by the end of next year or sooner, and 6,500 by the end of 2026 or sooner. So that's a 25% increase from here by the end of 2026. That wouldn't be too shabby a return from here, building on the kind of awesome returns we've seen in the market since the start of the bull market in October 19th, 2022. I think that the bull market, there's still a lot of questions about its breadth. I think I've tried to answer that question by pointing out that the breadth isn't too bad when you consider that the reason it looks like the breadth is narrow is simply because a few stocks have had just gigantic stock price increases, while many others have only been up like 20%. So they're still up by bull market areas. They're still up by something that's certainly plausible in a bull market, but not as much as some of the real leaders in this marketplace. But meanwhile, the market continues to do well, and there's plenty of stocks that have done very well, some more than others. And then past few weeks, actually year to date, we've had this remarkable stealth rally in utilities. It hasn't been stealth if you own them and you're in them, but it has surprised a lot of people. And now the interpretation is that utilities are the new play on artificial intelligence. AI data centers need a tremendous amount of power, and so utilities are going to benefit from all that. That works for me, and I think it just demonstrates that investors are increasingly moving towards our view that we're in a roaring 2020 scenario. I think we started to see the market discounting that back in the November 30th of 2022 when OpenAI first introduced ChatGPT. So let the bull market go on here. It may get a bit of a hit on Wednesday. We'll see what the CPI looks like. We like to follow the Cleveland Fed's inflation nowcast, and their inflation nowcast, I think, was showing that the headline inflation rate is going to come in at something like 0.4, and that the core rate will come in at a little over 0.3, and the year-over-year percent changes are both over 3%. So it may very well spark anxiety once again that inflation has stalled here at above 3%. That's still too far above 2%, and that means the Fed is going to stay higher for longer. We prefer to call it normal for longer. We think interest rates have normalized more than they have really tightened, and the economy certainly is doing quite well with this level of interest rates, and so is the stock market for that matter. Consumers also surprised everybody in terms of their strength. I mean, if you include housing as a consumer sector of the economy, which we should, that clearly has suffered. Single-family housing has been hit, but even that looks like it's making a comeback. I think as people get adjusted to the fact that mortgage rates aren't going to go back to 3 to 4%, but 6, 7, even 8% is kind of the range we're in now. I think anytime you get a dip in mortgage rates, you might find that brings some buyers in. So I think we've bottomed in the housing area, but it doesn't look like much of a recovery, and we're seeing that in anything that's housing related in terms of personal consumption, as we'll see in a minute. But let's turn to some of the charts that we focused on when we try to answer this question. Are consumers starting to crack? I suppose you can guess that given our bias be on the optimistic side, or at least on the balance side, we clearly acknowledge that there's areas of stress for the consumer, but we balance it off by showing you where the underlying strength remains. So it's hard to talk about a economy-wide recession with employment going up to new record highs. We'll see what the unemployment rate turns out to be for May when we get it in June. The initial claims last week spooked a lot of people because it increased by about 20,000. About half of that was New York State, and apparently that was related to the Easter, the spring vacation. Though the seasonal adjustment factor should have taken that into consideration, but maybe it didn't. Whatever, half of that increase was New York State, so maybe New York State is having a recession. The rest of the country is okay. But we'll all be watching initial unemployment claims as the indicator of the unemployment rate. And so far, it looks like may very well turn out to be the 29th month in a row where the unemployment rate stays below 4%. That's what I'm thinking. And so the labor market still looks fine to me. I'm not troubled by anything going on there. When you look at consumer spending adjusted for inflation, so that's in 2017 dollars. I want to make sure. Yeah, I like to look at the Q&A every now and then just to make sure that you can hear me and see me, as the Who in their song Tommy once sang. Anyways, I diverge here from the narrative that I want to follow, and that is, so here's a real consumption of goods, kind of flattish, moving up a little bit here, kind of a new record high. But what's fascinating about this is we all apparently went on a buying binge following the lockdowns. We couldn't really buy services because they were still basically in effect locked down through social distancing restrictions. So we bought a lot of goods, and as you can see that the real consumption of goods soared to a new high within a few months of the end of the lockdowns, and it kept going until this point here, and then it's been flattening out. So it's fascinating to me that people are spending an enormous amount of money still on goods. It's not going up as rapidly as it did here, but come on. I mean, this is the trend we had before, and we're still well above that trend line. So the consumer is still spending on goods. It's very important to recognize that. When you look at durables versus non-durables, the durables is the most interest rate sensitive, and that's this one here. And I don't know, I'm seeing a little bit of an uptrend here. So all in all, the consumer on the good side looks okay. Not fantastic, but certainly no recession there. You would think that if they went on the binge here, they'd be cutting back, and you'd see some recession in that kind of spending. Let's look at real spending on services and versus goods. So this is total consumer spending, and as you can see, it's been on an upward trend. And even though goods has been kind of flattish, the services has been rising here. So once we kind of pivoted away from buying goods because we kind of maxed out on everything we wanted, but apparently that's not an accurate description of what happened. Many of us maxed out, but there were still plenty that continued to buy, and adding up to a fairly high pace of consumer spending. Meanwhile, once we pivoted from this buying binge on goods, we went for services, and so that's been going up as well. And as I've said before, a lot of these services are related to demand by retiring baby boomers, and a lot of that has created record levels of employment in healthcare, in hospitality, hotels, motels, and restaurants, and so on. Here's a kind of an interesting chart where we just took the real consumption expenditures of goods divided by services, just to get a kind of a pinpoint of when the buying binge for goods might have peaked, and that was March 2021. So we all got released from lockdown prison. We were locked down in March and April, so we came out in May, and we came out swinging, buying like mad. This is my wife right here. She went to the local garden center and bought a nice outdoor furniture set so we could eat outside during the spring and not be cooped up in the house the way we had been. Meanwhile, what impact has higher interest rates had on the consumer? Well, I kind of gave away the answer, but you know what the answer is. Housing is the most interest rate sensitive item of consumer spending. Autos is also very interest rates sensitive, but in both cases, they didn't take a dive. They just kind of went sideways. So this is in current dollars, and it shows spending on appliances, furniture, and furnishings, and then it adds them all together, and that's kind of flattened out. Well, that makes sense, right? Existing home sales have been depressed. New home sales have been depressed. Existing home sales have been depressed, so people aren't remodeling and so on. And here's the Ardennes. Where is this? Where's the furniture and furnishings? Oh, this is us right here. We bought a couple of sofas right there. So that's where what we did coming out of the pandemic. Bought some outdoor furniture, some indoor furniture. We also repainted the inside of the house. So, but once we had done all that, we started traveling more. So, they say Peter Lynch always said, take a look at what you're doing, and maybe it's not that different from what millions of other people are doing. And millions of other people are spending money on services. A lot of them are retired baby boomers. They're spending on airfare, hotels, and motels, and you can see that's the sum of those will increase to a record high. Where are they going? They're going to fun-related services, gambling, recreation services, admissions, Taylor Swift concerts, um, Disney Park, and so on. So you put it all together, and again, you've got this record high in spending on services. I'm not seeing a recession here, a consumer-led recession, any of this. Now, having said that, we do expect that retail sales for April, when it's reported in on Wednesday, that's this middle category here. Well, it's the two categories: retail sales, including food services, and retail sales excluding food services. I think when the numbers reported by the press, it's usually the top line here, food services. We like to look at both of them. And I mean, retail sales is merchandise, food services is services. So here's our earned income proxy. So that's the red line. If you take a magnifying glass, you can see that it went sideways in April because aggregate hours worked edged down because the work week was down in April, and then on the other hand, that was offset by a slight increase in wages. So this proxy for wages and salaries and personal income looks like it's slowing, but it's done that before, and it's remained on this upward trend. And so we'll see retail sales look pretty good in March, but we could have a disappointing number in April. And let's just deal with it and assess whether it's just a temporary setback or it's a major trend change. And I'll view it as a temporary setback. So here's that aggregate hours worked. The payroll employment was okay. It increased, maybe a little less than expected, but as that average work week that declined, that brought it down. But this is a zigzaggy kind of indicator. And so right now it's zagging. Next thing it'll probably do is zigging. So we'll see how that plays out. But what drives consumer spending clearly is disposable income and adjusted for inflation. So we had a good upward trend here prior to the pandemic. Then we had all this noise here related to the government's stimulus programs, emergency pandemic checks, and all that. And then real incomes deteriorated when inflation took off, then kind of stabilized. And since 2023, it started to be back on an upward trend. And we think this upward trend continues, and that's what drives consumer spending. The naysayers are saying that even if this goes up, the savings rate may offset that by moving higher. The idea is that there's a lot of excess savings accumulated during the pandemic when people got their checks. They didn't spend it all. They had a couple of months back here not to spend much at all and save. And so there's actually an article in the Federal Reserve Bank. We quoted it this morning. I hate to say I think it was actually San Francisco, but it could have been New York. But at any rate, a couple of economists at the Federal Reserve came up with a pretty clever way of measuring excess savings. And guess what? They found that excess savings peaked March 2021, which is when we found that the goods buying binge peaked. And but consumers kept spending. They kept spending on services, and they kept spending at a high pace on goods. And so the excess savings thesis now is that, these authors say that excess savings turned slightly negative for the first time since all this excess saving occurred during the pandemic. So the excess savings story should be working right now. So March, April, May data should show a really weak consumer. And if it does, the diehard hardlanders, as I fondly call them, will whoop it up, have a great time saying, see, we told you so. They finally ran out of excess savings. They're not saving. But I think the incomes are going to continue to go up with employment, with wages rising faster than prices, partly because of a productivity story. I mean, clearly we could spend a long time arguing that one, but in the time we have, work with me here, and so that goes up. The story about excess savings, I don't think this goes up. I think it stays down. And I think what has been missed by a lot of economists is the retiring baby boomers are retiring at a rapid pace now. And so I don't think they're going to be saving. They don't have income anymore to save, and they'll be spending out of interest and dividend income if they're lucky. If they're not so lucky, they'll be dipping into their nest egg. So I don't think that goes up. If that doesn't go up, then consumer spending goes up at the same rate as disposable personal income. And so I think the economy continues to grow. We've talked about this over and over again. I think more and more people are picking up on this idea that the baby boomers have a sizable nest egg of over $75 trillion in net worth. And these are the other generations that are lagging behind. And I'm sure they're anticipating that mom and dad won't spend it all before they pass away. It might leave some to these generations. So these generations may not save that much, figuring that they're going to be in for an inheritance. Then we've got the statistic we've discussed before that 40% of people with homes don't have a mortgage. And a lot of them must be baby boomers. Here's this mortgage refinancing index, and you can see that a lot of people refinanced here. And clearly that must have had something to do with interest rates were at a record low, so they caught that. And so it looks as though the baby boomers aren't rushing to sell their homes. If they still have a mortgage and they refinance, there's no rush to move to somewhere else where they might still have to get another mortgage. On the other hand, maybe they've concluded that the kids are still living at home, after college, and maybe they still need a relatively large home. But whatever reason, we're not seeing a lot of turnover in homes, and that's affecting that spending on housing related goods. Autos, I mentioned, is very interest rate sensitive. In the past, it was a major swing factor causing recessions, especially back here. Not so much here. Yes, back here. And then, of course, it's been all over the place here. But notice it hasn't really taken a dive on rising auto financing rates, which is pretty impressive. And you can see the reason for that is people are continuing to buy these. They're called light vehicles, but they don't look very light when you look at them on the road. And there's a lot of them, and people just aren't buying sedans. You may have noticed that Buick got out of the business of one of its sedan lines. But this, I've shown you this chart before. It's really mind-boggling. It shows that 80% of retail unit light of motor vehicles is light trucks. That's the percent of them, and you can see that's up really quite dramatically. So again, you drive on the highway, you look around you, and you'll see there's a lot of monster trucks out there and big SUVs. And this is one of the reasons we've got inflation in auto insurance and in motor vehicle repairs. They're just very expensive cars to repair, and therefore also to insure. They're more expensive for sure. This is consumer credit by generations. So just the way you can see that the baby boomers have the bulk of the net worth. We're letting the younger kids have the bulk of the consumer credit. And so this purple line, the millennials, and it's probably not just credit card debt. I'm sure a lot of that is student debt, and Biden wants to forgive it all before the election. But you can see that's where they're at. The baby boomers are the blue here, and you can see that they've been kind of level at a trillion. This is home mortgages by generations, and again, this is the total, and the total has been absolutely flat, which tells you how much the market has changed. Home prices are a record high, so people have a lot of owner's equity in their homes, which is another stimulus to the consumer. But down here, you can see that the baby boomers have $2.7 trillion in mortgages, so they've been paying off their mortgages, and the other younger generations are seeing their mortgage debt accumulate as they buy homes. So consumer credit outstanding, people have looked at this and said, "Oh my God, it's over $1 trillion," and it's like, so what's your point? Well, I guess the point is not that consumer credit, revolving credit, causes recessions, but when a recession occurs for one reason or another, consumer credit can obviously make things worse. And so that was certainly the case back here, and it took a long time for revolving credit to bottom out. Back here, not much impact. Here, maybe there a little bit, but that doesn't particularly concern me, especially when you consider that revolving credit is 6.4% of total disposable income. But yes, we know that doesn't reflect the fact that it's bunched up in the debt obligations of younger folks. So when you look at this relative to generations, obviously, as we saw before, the younger households have more consumer debt and maybe more burden. And the question is whether the baby boomers' happy-go-lucky spending spree can offset whatever stress younger folks are experiencing. And my experience from my personal life and friends is that the baby boomers are engaged in a lot of intra-generational income transfer. They're supporting their kids either by letting them live with them at home because everything's so expensive, and or providing them some extra funding for paying off their credit cards and so on. I think there's a lot of that going on. That's really hard to document to show in a chart. So meanwhile, rates have gone up a lot, and so people who've been pessimists on the economy have said rates go up, the economy goes down, and so far that really hasn't been the case, except maybe for single-family housing. Delinquencies, nothing terrible going on here. The credit card debt is increasing, still under 10%. It's a little bit worrisome, but not too much so. It's nothing like what we saw back here, though. As we see, maybe the worst of the delinquencies occurs after recessions rather than going into them. But I'm not seeing anything here that makes me want to ring the alarm bell. Alarmists obviously are going to look at this and tell you, things are deteriorating very quickly and will continue to deteriorate. This is liquidity on the part of households, and you can see that the baby boomers have the most of it, $8.2 trillion demand, total deposits plus money market funds. And then you can see that the silent generation has 2.6 trillion. And then this is what Gen X and millennials have. So they've got less, but you'll notice that for all the talk about running out of excess savings, what is this increase in liquidity and liquid assets by at least three of the generations? The silent, obviously, are silent here on that issue, but they've actually piled up a lot of liquidity. So that's an interesting story there. Money market funds, all-time record high. So why are consumers depressed? We saw a drop in the consumer sentiment index. This CSI is particularly sensitive to inflation and particularly sensitive to gasoline prices. So here's real wages. Real wages for both for particularly low-income workers, production and non-supervisory workers, is back on its upward trend of 1.4%. So I don't think that's a reasonable. That's not necessarily an explanation for why sentiment is down, but clearly they are very sensitive to the price of gasoline, very twitchy about it, and the increase in the price of gasoline has led them to expect more inflation. And now that we're seeing the price of gasoline coming down, maybe they'll expect less so. So that's it. For those of you who joined late, we are doing a fashion show here with clothing featuring Max. Max is back. How do you like that? So maybe you heard me talking about him, but let's do some Q&A here. So far, I am seeing one question. So if any of you want to jump in with a couple more, be happy to entertain them, though we are getting close to the end of our program here, time-wise. The one question is, let me do the other glasses here. Do you think that this mem stock coming back today is a sign things are just not restrictive enough? Look, I don't think it's just the mem stocks. I mean, the stock market's had a great run. We've seen consumers spending, the economy's growing. Uh, Bank loans are slowing down, but a lot of that has to do with C&I loans related to businesses are being careful about their inventories. It doesn't look like credit conditions are all that tight. So, but again, I think we learned a lot again over the past couple of years about inflation. It's a complex kind of phenomenon, and it's not just monetary and financial conditions that drive the the productivity and the inflation rate. So I'm I guess we have to be somewhat concerned if we start to see speculative uh, excesses popping up again. But on the other hand, economy looks good. Inflation is coming down. The economy can live with these levels of interest rates. I actually worry more that kind of consistent with your story that maybe Fed officials are should be recognizing that 5.25, 5.5% on the Fed funds rate isn't all that restrictive. And nevertheless, suddenly we get an unemployment rate that jumps to 4.1%, and they kind of freak out about that and they start to lower interest rates. I worry about that scenario because I think that could lead to a melt up in a real speculative excess bubble. But at this point, I think they'll be sensible enough to hold off on lowering rates. And at the same time, I wouldn't want to see them raising rates because there are still problems out there. I'll acknowledge that as consumer, the not well, the lower end consumer, maybe lower income consumer, but certainly the commercial real estate market. Okay, we got our quota of questions here. Thank you. Uh, uh, Miriam, how is Max feeling about the market this week? Well, thank you for asking. Max doesn't think we're going to be making a new high here. I mean, as close as we're getting to it, he thinks we're going to kind of mark some time here. Um, so let's go to Paul. Good morning, Ed. When will the office-based commercial real estate shoe drop? I'm thinking one of the poster children for this with Pinnacle Bank and a Fort Worth, Texas office tower default. Well, the news is kind of trickling in there, and the market's kind of viewing it as one-off business screw-ups rather than as something that is a systematic problem. So I think the economy can handle, and I think the credit system can handle some blow-ups in the downtown office building marketplace without creating another banking shock, banking crisis, and so on. Last question from Cesar. What would concern you to derail the current stable economic situation? Well, I have been concerned and maybe unduly concerned about the geopolitical risks. I was concerned about the price when the price of oil was rising above $90 a barrel, but after Israel and Iran lobbed missiles at each other, and then things kind of quieted down between them at least. The price of oil took a dive, suggesting that the premium, the geopolitical risk premium in oil was something in the neighborhood of $5 to $10, which is interesting because it also confirms that the global economy isn't red hot. There isn't enough demand to keep it at 90 or higher, which is good on the inflation front, certainly for the United States. I've been thinking about the domestic political situation, but that's a tough one. See how this thing unfolds between Biden and Trump, and how close the results are, and what kind of messy partisanship that leads to once again. Look, I'm getting some feedback here that maybe rent inflation isn't going to come down enough to really help bring inflation down. I'm still looking at Zillow and apartment rent kind of indexes, and they look okay. But one fellow said that his rent in New York City just went up 6.5%. But I think a lot of construction has been going on where people have been moving to, and that's just down south. And it seems like the construction there has kind of come to a halt, maybe because they've overbuilt, and that's where we might see some rent disinflation. So never a dull moment. We've got some exciting news coming out this week, not by us, but by the government on the PPI and CPI. We'll be working on those numbers and communicating with you through the morning briefing and the quick takes. And join us again next week. I always appreciate this very nice turnout, and so does Max, though you wouldn't know it from his sleepiness here. But anyways, thanks again.